On January 20th, Ray Dalio, the billionaire retired founder of Bridgewater, one of the world's largest hedge funds, told the Financial Times that rising interest rates and gilts, those are the bonds issued by the UK government, combined with weakness in the British pound sterling, could signal that the UK may face an impending debt-death spiral. We're going to talk a little bit about debt-death spirals today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. So rising interest expense leads to more borrowing. More borrowing at higher rates increases interest expense, fueling more borrowing and creating a negative feedback loop. And the reason I bring all of this up is because, of course, we've been seeing and hearing quite a lot about all of this lately with respect to the Department of Government Efficiency, which has apparently been shut out of the Department of the Treasury. This comes at about the same time that the GAO, which is the Government Accountability Office, which is what it's now referred to, this was founded in 1921, and it is a part of the legislative branch of government. So what the GAO is supposed to do is try to audit and identify things like waste, fraud, and abuse. And I bring this up because some of the statistics, and they recently came out with a report, it was actually published on February 5th, so just last week, that says that the U.S. government is currently on an unsustainable fiscal path. And I encourage you to go to the GAO.gov and read some of their reports. They make for very interesting reading. In any case, a couple of things, and I've touched on this in the past, but I often like to try to put some perspective on the numbers that get thrown around because they can be really hard to comprehend. We don't really digest how big the numbers are at times. So there's really two categories that I want to talk about today, what they amount to in the aggregate and how much that really amounts to and what what this really means and why it's so important, not just to the current administration or to Republicans, but to everybody. And, here it goes. I'm just going to speak, as I often do, with a little bit of generalizations with respect to the numbers. Know, though, that these reports get very specific and you can go and identify those. So first things first, the fraud portion that the GAO has estimated is coming in between 2018 and 2023. Their estimate of fraud is between $233 billion a year and $521 billion per year. We've previously also spoken about improper payments. These are circumstances where the federal government has spent money, and apparently, in their analysis, most of improper payments come in the form of overpayments. I think it was something like 75%. That, too, came in at around $238 billion for the most recent year. And here's the really eye-watering statistic. The total of improper payments, so I'm not talking about the fraud, but the total of improper payments that the GAO estimates has taken place since 2003, this is in a report that they published in October of last year, is $2.7 trillion. Let's think about that for a second. So $2.7 trillion over the course of the last 20 years is about, it's in the same order of magnitude as the GDP of France. It is a number, so there are various statistics out there that talk about the U.S. housing shortage, between 4 and 7 million housing units. The average median single-family home at the moment is about $420,000. But this, remember, occurred over a period of about 20 years. Effectively, that is enough money to satisfy the entire U.S. housing shortage and then some. Let's think about it another way. Let's think about it for something that, people who are looking for a handout, such as people who are looking for free college, for example. There's less than 20 million college students in the United States, and in-state tuition averages about $11,000 per year. So just the improper payments, and much less than the estimated annual fraud, is sufficient to cover all of them. So this is the kind of scale and scope of problem that we're talking about. GDP of France, all college tuition, in-state, in any case. And actually probably private too if you put both fraud and improper payments together. And the reason I bring this up, because I don't know what political affiliation everybody who's watching this might have, but one of the things that I have seen is that there's a lot of pushback, seemingly from Democrats at the moment, about the activities of the Department of Government Efficiency. And an important thing to think about is that the GAO, as it is part of the legislative branch, is talking a lot about things that should have taken place at Treasury. They themselves said that they should use advanced data analytics to investigate what was going on, and Treasury agreed. This was in their report that was issued in April of last year. So this is Biden's Treasury concurred with the assessment of the GAO, and people have said, well, if the GAO is doing their work, isn't that sufficient? Well, the thing is, all they can do is say, hey, you've got something going on here, and you ought to do something about it. But they cannot do something about it themselves because Treasury is part of the executive branch and the GAO is part of the legislative branch. And one of the things they specifically talked about was creating an entity like the Department of Government Efficiency. And it should be said that this is something that has happened at times in the past. Truman tried to do something like this. Reagan tried to do something like this. I would say that the most successful administration at actually doing something like this was Clinton and Gore. They made a big show of it, actually, it should be said. And in conjunction with Newt Gingrich and Dick Armey in the Congress, so you had Democrats in the White House and you had Republicans in the Congress, they actually managed to achieve a balanced budget. This was not without material concessions from both groups. And it should also be said that had it not been for a single vote in the Senate, we could have ended up with a balanced budget amendment at that time. It failed, I believe, by a single Republican senator vote, as it happens. And this is something I've been ranting and raving about for quite a while. I actually spoke about this. I led a keynote speech at Drexel University in 2011 with this exact topic. And one of the most important things I wanted to add to this is that balancing the fiscal budget is only part of the problem because we still have to contend with unfunded liabilities. And this, by the way, it should be said, is something that Bill Clinton was also trying to resolve in the latter stages of his presidency. Unfortunately, due to his own personal failings, he ended up as a little bit of a lame duck. And he had people like Jose Panera. You can look him up as well if you don't know who he is. He's a Harvard-educated economist. He's from Chile. Chile also had essentially a real crisis on their hands, and he helped correct it. So he was essentially their equivalent of the Secretary of Labor, and they had these defined benefit plans that were created, and they needed to do something to create some form of solvency. And they essentially did something akin to privatizing their version of Social Security, and it's also a very interesting topic, and if you can, you might be able to find I don't even know if Jose Panera is still alive, but he was a very good speaker. I saw him speak in person, and he had some very interesting ideas. And look, none of these are perfect solutions, but I think it is really important for every person, every citizen to be concerned about this and to want something to be done about it, because it is not sustainable. If you consider just what the implications are for, let's just say that improper payments and fraud collectively work out to about $5 trillion over the course of the last 20 years. All of that has essentially been added to the federal debt because every incremental dollar spent goes into the federal debt, and our cost is, closing on 5%. So these are massive numbers. That's $250 billion in interest on improper payments and fraudulent payments made over the last 2 decades alone. That essentially is free college tuition. That's the interest on those improper payments. So please, as you watch all of this, whatever your political affiliation, give those numbers some consideration. It is not a big problem. It is the problem. It is the most important problem facing the nation. Whatever else you want to solve, and I don't care what it is, whether I agree with it or not. And there's plenty of things that I'm sure a lot of college students, for example, would want. I happen to have relatives in the Netherlands. They get free college tuition, they get free housing, they get room and board, and they even get a stipend. And I'm not suggesting that. In fact, I would actually strongly recommend against it because my own cousins knew people when they were in college who said that they only signed up so that they could get the stipend. They weren't even bothering to go. So that's, you clearly don't want to create these perverse incentives. But if you are concerned about allocating resources, you must first be concerned about protecting them. So I will leave it at that, and we can move on to other topics. And today I'm going to try to do something a little bit different. So I'm often showing my Bloomberg terminal, and a couple of people have asked about this unusual whales application, and I've been playing with it a bit over the course of the weekend. And so I'm going to attempt very clumsily, this is my fault, by the way, to navigate any questions that I'm going to take using this application to see how we can try to divine the answers that we want using it. And there's a couple really slick things in here that I think are kind of interesting. So we're going to get into it a little bit with this. And one of the things I wanted to point out is that a lot of the information that I have been displaying on my Bloomberg terminal is actually available here in a form that I think has a lot of utility when it comes to, for example, trading catalysts such as upcoming earnings. And I figured I would use that as an example. And I see here we have a couple of questions, so I'm going to get to those hopefully. But let me just show you what I mean, because I think somebody was also asking me about this. And by the way, I found a couple things that could be user error. I've actually reached out to the folks at Unusual Whales about things that I've seen that I think are really slick, but they didn't appear to be working for me. But it could be something I'm doing wrong. In any case, I'm going to point that out because these are really important considerations that oftentimes when you hear ideas cast about, options trades, do this, do that, are not really discussed. So let's go through some examples of this. And I'm just going to take a look at the earnings calendar because we have a couple more names. And you'll forgive me when I'm always touching my ear. The reason for that is I have an IFB in there so that the production staff can yell at me when I do things wrong, which is going to be very often. But it doesn't fit quite right, so it keeps popping out. And I might even just ditch it at some point during this show. I actually asked them whether it would be all right if I wore a headset. They think it doesn't look very good. Okay, so let's just take a look. And I can pick any name at random here. Why don't we just pick MGM, which is going to be reporting on Wednesday. Oops, that's economic calendar, earnings calendar. We'll pick a name like MGM. They're reporting on Wednesday after the close. And if you click on it, you'll immediately get taken over to this earnings tab in the Ticker Explorer. Now, I showed you guys this last bit so we can see what the implied move is. And you can see that the implied move in MGM is larger than it has been over the preceding 7 quarters. Oh, we can go back a little bit further still and see actually it looks like it might indeed be as big or larger than the implied move in any of the last 11 quarters. Once you've done this, I mean, that's has some utility. It tells us that options are more expensive than they have been going into this catalyst than they have in the past. But it doesn't really tell us the rest of what we might be interested in knowing, which is, for example, how we feel about the stock. So if I just drop into, and the reason I don't know whether they have trials or don't have trials, but it's not a really expensive application, certainly not compared to the Bloomberg, and a lot of the things I've been showing you on there are here too for, I don't know, 1% of the price, something like that. You'll forgive me, I don't actually remember exactly what it costs offhand for retail, but so you get your price chart and things like that. But what we're really interested in, and what we were just talking about, was volatility. right? So we can quickly see here what the implied volatility rank is, and we can go back, for example, a year if we want to do that, or just take a look. And you can see the seasonal impact. So this is 1 year. You can see exactly where earnings are, and you can see just how pricey options are going into this particular event. This is the term structure that I often show. And skew. So there's a couple ways to think about skew. Skew, a lot of people will talk about it just in terms of, say, a 25 delta put versus a 25 delta call for any given expiration. So as you go through the term structure, obviously you have to pick which expiration you're looking at. So if I'm looking at regular way for March, you can just drop that in here and just see whether it's skewed. And this is, by the way, by default, they are looking at put minus call. Sometimes I will, if you're looking at the way I display it, sometimes it depends on how I order it when I pull up my vol screens, because you actually have to construct it. It doesn't go to it by default, or at least not the way I have it configured in Bloomberg. So if it looks like it's backwards, sometimes that might be what's going on. Here they actually do sort of set it by default. And this also is going to give you some sense of what the realized volatility is, where we are in terms of the history with respect to that risk reversal. So risk reversal, long call, short put. If you put it on the other way, long put, short call, that's more commonly referred to as a collar, but it's basically the same trade, just the opposite side of it. And things like that. But this is where I think you can get some additional utility. If you happen to be looking at this, you want to know what the analysts have been doing. And notice it just sort of just flows right down here. The reason I'm going to start, and by the way, I switched this over to dark because I know that some of you had commented that it might be a little bit easier to see in this context. It'll never be perfect for everybody. But yeah, so you can then go in here, and so this is that ANR screen that I typically show on the Bloomberg terminal. You can see, the ratings, which house is issuing them, the name of the person who's done it, what their targeted move is. So that's essentially the current price relative to their price target. We can take a look here. This is what I had brought up before. I'm working my way down now, so this is the earnings. Now, what I think is kind of interesting is this part here. So I hadn't shown you guys this screen before. Normally, and I think this might be easier. I do have my Bloomberg terminal running here somewhere. Let me see if I can pull up a window so I can just show you guys really quickly. So when I do this screen, FA, right? So this is financial analysis, and it just takes me to a parent thing. Usually the things that I'm pointing you straight to are the market capitalization, maybe the enterprise value, so we get some sense of the net debt or net cash that the company has. But what we're really trying to take a look at is the growth rate, the top line growth rate, earnings growth rate, and things of that nature. And here, you get those numbers, but it's also being displayed visually. You can hover over these things if you want to get a little bit more specific. So, some pretty slick stuff. And insider transactions, I find this to be very helpful. Are insiders better buyers, better sellers? We obviously care about those things. Oftentimes, going right into an event, you're not going to see anything because they're not really supposed to be transacting at that time, but I think that's also quite interesting. Okay, so that was just a quick walkthrough, and with that, I'm going to try to get to some of your questions, and we can see what's going on there. Okay, so Monday morning quarterback. Greetings from Orinda, not far away. Not that far, I guess. East Bay. I have a March 14th 50-60 collar against my IBIT, which is the Bitcoin ETF. Please discuss the negative skew and whether you prefer a different trade given that we could have a correction soon. So, well, yeah, I mean, let's talk about that. negative skew. Okay, so I usually don't think of this skew as negative necessarily. Okay, so let's talk about that. So negative skew to me are circumstances where the puts are trading at a big premium to the call. So whether you're looking at it on a delta basis, so 25 delta call versus 25 delta put, a sigma basis. Sigma, by the way, is just another way we can talk about a standard deviation, right? So up 1 sigma, down 1 sigma, up a half, down a half. So for most equities, and they probably have this function in here, but I'm actually going to pull up my Bloomberg for a second so we can talk about this. So most equities have, and certainly the broad market, have negative skew. And I've discussed this before. Part of that is supply and demand driven, which is that there is natural flow where people sell upside calls to collect premium, and there's natural flow where people buy downside puts to purchase insurance. That is not the only consideration, though. So the other consideration is how the underlying actually behaves. So for some assets, what they say is take the stairs up and the elevator down, which is to say that price jumps or gaps, if and when they occur, are more likely to come on the downside. In other words, the distribution of returns is not symmetric around the mean. So this is a normal distribution, this orange line here. And the distribution is not necessarily symmetric around that. You might get, big outliers to the downside. And actually, here we're looking at SPY, so proxy for the S&P. And that's exactly what we see in this picture, right? So if things were normally distributed, then you could use one volatility as an input to value all options. But in fact, we can't do that because the price behavior doesn't adhere perfectly to a normal probability distribution. Two of the important characteristics that this picture shows us is that, one, instances around the mean occur with greater regularity than a normal distribution would predict. And the tail events here and here happen with somewhat greater likelihood as well. And these near ones, up and down a standard deviation or so, happen with less frequency. I mean, it's not perfect, of course, but you get the point. Also, you're going to notice that the general meat of this distribution is shifted slightly to the right. I don't know whether Bloomberg's normal distribution is around the forward price, which it should be. It might not be. This picture suggests maybe it isn't. But what we can see is that there are generally gaps in here. So when you have fat tails, thin in the middle, I've previously explained that when the distribution is different than a normal distribution, we describe that as kurtosis. Whether it's skewed one way or the other is skew. And we can see that you do, in fact, get these outlier moves to the downside. So these are things that would justify more events at the tails. That justifies a smile. Bigger events to the downside. That justifies put skew, meaning that the put implied volatility is higher. And, otherwise the volatility is a little bit lower in the middle, reflective of the fact that returns tend to be concentrated more closely to the mean than a normal distribution would predict. Okay, but there are assets, not all assets behave like equities. Good examples of assets that don't behave like equities are highly volatile, we'll call it commodities. I mean, so things like electrical prices, because you can't store them, tend to be very volatile. Natural gas, which is somewhat more storable but not perfectly storable, will also exhibit these types of characteristics. And you can get into a situation where things will have potentially some call skew, so that it sort of accommodates those upward moves instead. Now I'm moving over to IBIT, and we can see that the distribution here takes on a different shape. And the results that we see over the course of what are we looking at here? So this is just a 1-year history. Also is a little bit different. So these are things that justify a slightly different shape to the volatility surface, right? So you're going to find, I'm going to get rid of that one. You're going to find that at least up 10, down 10, well, this has still got a little bit, so there's a little bit of concern in here. But if we go back 1 week, so this is going, I just want to, and again, I'm sure this is easy to show on Unusual Whales, and I'll figure out how to do that in the future. Because I'd prefer to use tools that are more accessible. And frankly, if I can find a way to get everything I need out of that thing, I'm starting to wonder why I'm paying the big bucks for this one. Anyhow, we can see that there has been a shift, and the bigger shift in implied volatility over the course of the last week, going out 3 months or so. And why don't we take a look? And you are looking at March. So actually, I shouldn't be going out 3 months. I'll just pick March. March regular way, maybe? You didn't specify. I'm just going to assume they're regular way March. Okay. So here we go. That is this now. So what do you do when you have this kind of a dynamic? Well, if you put the collar on when, say a week ago, when the vols were here, like at this red line, and now you find them here, so your short call, long put, long underlying stock, what you may want to do instead is actually dump that sort of synthetic position and be short put, long call, get paid kind of a thing, right? So you can, or maybe buy a call spread. So that would be buy something at the money, sell something up here at about roughly the same vol, and sell some lower strike downside put to help finance, or maybe even completely finance that purchase. And if you start to see the upside implied volatility rise in your long upside vol, that's another way you could potentially profit or benefit. So one thing I will say is that concern about what this tells us is that concern about the bottom falling out, that hasn't mitigated all that much, right? So this is 20% to the downside out to March, and you can see that the implied volatility of those options is very close to where it was a week ago. It's everything else that has dropped more precipitously. And that probably also coincides with the fact that day to day, the volatility of Bitcoin has dropped a bit, right? So that's what you're going to see when day to day you get, you go up 2-3%, which is a lot, by the way, for a stock, but not so much for Bitcoin. Up 2-3%, down 2-3%. Then you're going to start seeing the at the money volatilities come in, because there should be some relationship between the volatility implied by options prices and how much is actually realized. And here's something else to think about. I think I've said this before, but you can always calculate, if you're just trying to get a rough sense of what something means, you can take the annualized implied volatility. So what do we have right now? This is at 50%, right? So how does 50% implied volatility translate to daily moves? Now, what many people will say is that you want to take that number and divide by 16. And they're saying that because they're taking an annualized standard deviation and turning it into a daily standard deviation. But the average move and the standard deviation are not the same. The average move is statistically the same as the mean absolute deviation, which is about 80% of the standard deviation, which is another way of saying that you should actually divide that number by 20. And what did I say? 2 to 3% a day. Take 50, divide it by 20. What do you get? 2.5% a day on average. That's what you should expect. So anyway, hope that is a little bit informative, but that's just something to think about. I still think that you want to be long Bitcoin, my 2 cents. All right, PC says, Mike, when selling Strangle using IM. What to do under different scenarios after an earnings release. Did I share that with all of you? Hopefully. I'm having a little bit of a brain lapse here. When I see IM, I'm thinking Ingram Micro, which is actually one of the first stocks I made a market in back in my days on the Philex. What are you referring to when you say IM? I'm going to put this thing back in my ear in case it's obvious and it's just escaping me at the moment. I'm going to have to probably come back to that question because for whatever reason I'm having a lapse and I'm not... Okay, so... FinWest, yes, good morning, Mike. Another week of earnings to look forward to. Well, and that's where I think this thing is pretty slick, right? You can just go into the earnings calendar. It just shows you everything that's going to be reporting when it is, and then if you're interested in that one, oh, Kinross, what's going on there? You just click it, takes you right to earnings. You're interested in taking a look at the financials for this thing. One little quirk that I happen to have noticed is that so if anybody from Unusual Whales happens to watch this, let me just show you something which it's a bit quirky. I haven't seen it happen in other contexts, and it may be a feature, may not be a bug. It's just something I happen to notice. We'll take a look at Albemarle, one of the banes of my existence, this one. So if you go over here into Ticker Explorer, which is where you can find all of this additional information, you get an overview of the company, you can look at vol, you can chart it, analyst ratings, whatever. If you click one of these, it closes that submenu. Not sure why, because it sort of strikes me that the natural course of things, if you're going through the overview, all right, well, then I want to look at charts, and then I want to look at vol and gamma exposure, Vanna charm, all this kind of stuff. But yeah, that's kind of an interesting thing. So I encourage any of you who have this, check that feature out. That's kind of cool. Okay, let's see here. Michael Walter, when is an option considered expensive or inexpensive? Excellent question. Excellent question. Couple things to think about. All right. And I'll probably leave out some vital points, but I'll try to cover a few things in turn. What are the things we care about? Well, the first is, as a market maker, the thing that you care about is realized versus implied. Realized versus implied volatility is the thing that you care about. I'm going to get rid of the stock price. So as we look at this is this lower right-hand corner over here. This is the one you care about. Why is that? Because if you're a market maker and somebody comes in and buys straddles from you, so you short straddles, you're now short volatility. You will make money if realized volatility over the course that you hold this position, assuming that you hedge it dynamically in some prescribed manner, and that what you capture is roughly equivalent to what realized volatility is. And those aren't always going to be the case, but in general, if you sold it in implied volatility higher than what you realize over the course of being in that position, you make money. Right? You'll make approximately the difference between the realized and the implied. Times your Vega at the time that you initiated. This is kind of back of the napkin types of things. It's not quite as simple as all of that, but it's a good idea to think about it that way, right? So, if I collect $500,000 in premium and I believe that it is 20% overpriced, 25% overpriced, let's say. So that means that I actually think that straddle should have been $400,000 in premium rather than $500,000, and I'm diligent about hedging my deltas in a systematic way such that I get the realized volatility. Then I expect to make $100,000. Okay, so that's the first way we can identify whether vol is high or low? Is it expensive or cheap? There are other things, though, that we have to think about because volatility isn't constant. And we talk about this quite a lot, which is to say that what looks expensive or cheap right now may not be when we take a look at something like the earnings calendar. And the best example of that is, let's just pick something, right? Let's pick something that's got earnings that typically moves around a decent bit. We were looking at MGM earlier. So let's just take a look at this one, right? So here we go. Oops, I need to expand this a bit. So this is that seasonal effect I was talking about. This purple line is the implied volatility rank of MGM. But that rank, you notice that, it's very high at these handful of periods. Why is that? Well, that's because that's when the company is announcing earnings. And what you will notice is that, generally speaking, you're going to see higher realized volatility around that same time. And sure enough, take a look. Realized, implied. Realized is in yellow here. And you can see very clearly. So just because the IV rank, if you're looking at it over a big window of time, but you're not being that contextual about it, just because it's high doesn't mean it's high enough. So you really need to be able to look and say, okay, what do we think is going to happen here? So the implied volatility is high. It's about the same as it was for the last earning, and it's higher, indeed, than it was the ones immediately before. Is it high enough? Well, that depends. It's not if you think that we're going to get another move like the one that we got, in the summer of last year. So how do I like to think about it? First, by the way, the difference between options implied volatility and the realized volatility, you'll sometimes hear people refer to that as the volatility risk premium. More often than not, we think about the volatility risk premium on the index side because it tends to be more consistent there. Obviously, you have catalysts, but the catalysts aren't as impactful as quarterly earnings releases are for single stocks or corporate actions. Nobody comes out and says, we're taking over the S&P. So that kind of idiosyncratic event doesn't exist in index land. You have big market moving events, tariffs, no tariffs, interest rate hike, interest rate cut. Those are the kinds of things that can move the market fairly broadly. So it's not like volatility is completely constant, but you don't get those really big idiosyncratic. You don't get pre-announcements. You have pre-announcement season, so you could have a number of companies get chopped up, and that will impact the market. But those types of things, so the volatility risk premium tends to be a little bit more consistent, or the way we think about it on the index side. Plus, when we study that data, it seems to be pretty consistent. So that is definitely something to think about. So when I think about whether options are expensive or cheap, I compare realized to implied. I take the context into account, which is whether or not there are catalysts and what volatility has typically done during similar periods in the past. Earnings is an example. It's not the only one. There are different things that can impact companies at different times, seasonal impacts or event impacts that are identifiable. For example, retail names might have higher volatility in and around the Christmas season when they do a big percentage of their sales. If that's really important to them, that can be very impactful. Companies that depend on hospitality or travel, again, similar sort of a dynamic. Companies that are involved with, it could be the natural gas business in and around the shoulder months, which are the tail end of the injection and withdrawal seasons. All of those things can have an impact. And finally, and this is where things get both more interesting and admittedly a bit more complicated, there is relative volatility. That is to say that maybe I don't mind overpaying a little bit for single stock vol, realized versus implied. So maybe it's implying 25 and it's realizing 23, so I'm paying 2 clicks over in theory. But maybe I don't mind that very much if I'm able to do it in 50 different stocks and I can get it on a weighted basis and sell index volatility 5 clicks over, what it over realized. So as part of a broader trade, sometimes you should be okay paying a small premium if it puts you into position to sell a bigger one, right? So there's that relative thing. And you can also take a look at it on a pairwise basis, stock by stock, sector by sector, stock versus sector, all of the sectors versus the index. I mean, there's so many ways to slice and dice this kind of stuff. And I encourage you to kind of think about it and play with it. But those are sort of the principal ways that I think about it. So just to recap all of these. Realized versus implied. Take seasonal or idiosyncratic events into account when you do this. And then also take a look at relative volatility. Realized and implied for whether it's constituent stocks, individual stocks versus each other or versus an index. All of those things are going to play into it. But I will say this, that if the implied volatility rank is high and you don't have an identifiable catalyst, and there's not too many other reasons other than maybe something just chopped it up recently that you think would continue over the near future, one final point that I would make about volatility is that in the absence of other inputs, a statement we can make is that it tends to be mean reverting. And that mean reversion suggests that when implied volatility rank is high, all else equal, it's probably a better sale. And if it is low, it's probably a better buy. But remember that there's a lot that plays into that. So just taking a look at a 3-year history is insufficient, right? If you've got earnings coming up, it's going to look different than if they've just passed. And you kind of have to think about that. Hope that helps. Okay. I would love to see an analysis of what parties profited from the improper and fraudulent payments, individuals versus private companies versus public companies. We were talking about this before I came on today because it's just this whole thing has my blood boiling. It's so important that we get a handle on this. And one of the points that producer Jay, who's in my ear right now, made was, are there some who probably got rich from improper payments? Are there some who got rich from fraudulent payments? I'm sure there are. It's probably likely, though, that there's just vast recipients who are getting more than they should. They don't have any incentive to point it out. And some of them, of course, are directly responsible, but they're not necessarily getting rich. So one of the areas of fraudulent payments that they believe are areas of benefits, for example. People who are not entitled to benefits, receiving them for one reason or another. In the aggregate, that adds up to a tremendous sum. But that doesn't necessarily mean that any one of those recipients is getting rich. It does mean, though, that you could have, people in society who aren't doing the right thing and who could be doing something more productive if they weren't improperly taking government funds. So I have a feeling that it spreads out across a broad swath of businesses and individuals where the amounts of improper payments and frauds are not hugely meaningful to those for whom it is immensely meaningful. Consider that we just had in the news, they arrested a bunch of people that were on a COVID fraud thing. There were 7 people, and they tried to improperly collect $600 million. Now, that obviously is incredible. I think they were based in New York. It was something that my friend and colleague Mark Guthner pointed out, and they actually got caught. $100 million a person? Okay, that's get rich quick fraudulent types of money. But people who are improperly collecting other forms of government benefits aren't necessarily getting rich by doing it. But in the grand scheme of things, we lose their productivity and we lose I'm not going to say tax revenue, because like I said, a lot of the stolen money, improperly allocated money, is borrowed money, right? It's not even like they're taking money we have. We're putting it, they're improperly using the nation's credit card. And everyone else is going to have to pay that back. That's really a disaster. Finwest, unusual whales is even more impressive. Thanks for sharing. It's more impressive than what I'm doing with it, and that's only because I'm working my way through it. But the more I play with it, the more I like it, and I think it's and I do think that it's important to show applications that are not as expensive as a Bloomberg terminal. And if I can get to that, one of the things I really like about the Bloomberg terminal is my ability to do research on the credit side. It's really, and that's not something we talk about much here, and maybe there isn't even that much need or use for it, but, and I'm not even a credit guy, but it does play into some other things, so. Don't get me started on Albemarle. What's your outlook on the stock this year and in 2026? It's funny you mentioned that. I wanted to do a little bit of work on it and intend to this week. Those who follow me probably know that it was a name that I was kind of looking for a turnaround last year. And obviously that's not what happened. Does Mike know about Market Chameleon, a very useful option analytic tool? I don't know. That sounds familiar. So that would, I guess, be this. Market news. Yeah, I have not played with this. Haven't used it. But interesting. Yeah, I'll take a look. Thanks for the suggestion. And one of those things I should also just quickly point out, which is that it's probably the biggest sin of all Bloomberg users, and people who use it's a funny thing because Bloombergs are usually, in my case, I pay for it myself, but Bloomberg terminals are generally sort of a default system that is given at a lot of institutional firms. So, when I was at Cantor, when I was at CRT, when I was at Ivory, everybody had one. You use it to communicate with one another. It's sort of the default. Everybody builds spreadsheets. The spreadsheets use Bloomberg APIs, and we pass them around. If we were looking at a company, we primed it, I think, JP Morgan, Morgan Stanley, Goldman Sachs. I'm talking about my Ivory days now. You could look up an analyst and say, oh, they cover a stock that I'm looking at, and you could call them up and say, hey, send me your model. And whatever model they had, they would usually just send it to you. So you just get their Excel model, and everybody's using Bloomberg. So you just take the thing, you open it up, and it just auto-populates. And so it makes for a very convenient and easy workflow. And the thing is, if you're a trader at Goldman Sachs or Morgan or Cantor or CRT or Jefferies, it doesn't really matter. You're not thinking about the cost of this thing. It just sits on your desk. Everybody uses it, and it's used as a messaging tool as well. So consequently, you're not going to debate about whether you could get that information another way for a whole lot less money. It would also be weird if another trader is trying to reach you. You're not on a Bloomberg, Who are you? Where are you? It's kind of a default. And actually, I'll give you an example of this, because I think probably a lot of people who are thinking to themselves, who uses a Bloomberg and why? You can find pretty much anybody on these things, right? So we were just talking about Albemarle. So for the sake of argument, I would say, oh, well, I want to know, who covers it. Oh, look at this guy, Arn over at RBC Capital. He's, he covers this thing. So then I'm just going to say, well, is he on the Bloomberg terminal? So I can actually just search for him. Aaron, and did I? And of course, I need to remember how to spell his name. I should have picked somebody whose name was Bob Smith. Viswanathan. And watch this. Maybe he's not on it. And here he is. So now I can get his contact information pretty easily. Give him a little click. And this is interesting. See, there's no dots over here. And I can also see how many people looked for this guy today. Well, apparently 6 people wanted to know who he was. I can get in touch with him this way. Now, chances are, if it's the Goldman analyst, by contrast, let's find whoever that is, if there is a Goldman analyst. And actually, I don't see them right here, so let's pick something a little bigger that we know there will be one. Citi, JP Morgan, Goldman Sachs, Eric Sheridan. Okay, so Eric Sheridan covers this one, so I can give him a look. Here he is. Well, this is interesting. Everybody's dropping their Bloomberg terminals. I actually don't see a quick link to him in here either. So normally, so you see that? Maybe everybody's getting unusual whales or market chameleon. Normally, what you would see is a little green dot or a red dot or a gray dot or a blue dot next to them and a little message window. So I could just click it. So if it's a blue dot, that means they're on their mobile, but they're on the Bloomberg. They have a Bloomberg, but they're on their mobile. A gray dot means they're trying to hide whether they're on or off. Green is they're on, and red is they're off. And sometimes you'll see yellow. That just means the guy stepped away. It depends on how it's configured. But this is kind of an interesting mechanism because it means that you can just reach out to people really easily, and the communications can also be viewed to be nowadays, because they keep track of all of this stuff, that it's actually a compliant means of communicating with one another. So, for example, in the days when I was at Cantor, you were not allowed to have a mobile phone on your desk. You could not communicate with people using a private thing like a mobile phone. In fact, we were only, at the time when I was first there, I can remember when the iPhone came out, because a lot of people were like, oh, these iPhones are awesome, they're so cool. They wouldn't let you use them. You were supposed to be on a BlackBerry because the firms have to track all of the communications. So you used it for your email, your phone calls. And of course, this makes good sense. You can't have people on an institutional desk listening to what other people are doing, making private conversations to God knows who. It's a real potential source of real-time information leakage. So I remember it took maybe a year and a half or 2 years after the release of the iPhone before they had figured out how to make that compliant. And of course, once they did, nobody wanted a BlackBerry anymore, and they just cratered. And I can still remember on CNBC my colleague Dan Nathan saying that BlackBerry was going to trade down to a, quote, hat size, unquote, at the time. Now, what did I do with my question window? I had that up, and I misplaced it, so I'm going to, forgive me while I get back there. Live stream comments. Okay. Let's see here. I'm sure, are there any other questions that I can get to? We're closing in on the hour, so I just want to make sure if there are some other questions that I try to answer them if I can. I think we're actually pretty good here. Yeah, so just to highlight the things we talked about today, expensive versus inexpensive skew. So expensive versus inexpensive, realized versus implied. Look at the context. That is to say, if you're in and around a quarterly earnings release, then presumably implied volatility will be higher and it may indeed be substantially higher. The implied volatility rank will be higher if it doesn't look at that in context. Our systems used to do that, so we would automatically back out event variance to calculate the relative, and we would actually look at both. So we'd back out the event variance and then see how the event variance compared to its own history, which, by the way, Unusual Whales does that. That's what that earnings implied move versus realized is, right? So when you go down and you're looking at this thing and you're saying, oh, okay, I'm going to look at earnings, this section right here, that's what that's doing, right? So, and not a lot actually do this part. So those columns tell you how big the implied moves were historically. So the next step is then to say, okay, once I back that out, what is the underlying volatility's process relative to its own history and behavior, right? So that's certainly the thing. How does it compare to other stocks? Oh, and this brings up one other point too. Generally speaking, companies report earnings in the same sequence within the same industry, but not always. And I'm trying to think if I can offhand remember a perfect example of this. I want to say, and I'm going by memory here, so forgive me if I got this wrong. I think, is it Target that reports their annuals later, but their quarterlies earlier? Let me see here. So Q4, March 5th. And, okay, and then we're going to pull up Walmart beside it. So I may have this backwards. So they put their annuals out first. Yeah, so Walmart reported last year, they put out their annual on February 20th. The preceding quarter, they reported on November 16th. Remember that. Now look at this. See, my memory is not so terrible. Sometimes. March 5th is when they put out their annual, so after Walmart, but the preceding quarter was November 15th, which was before Walmart. Now, I'm not saying that Target and Walmart are perfect proxies of one another, but what I am saying is that it's not enough simply to look only at a single company's potential catalyst when you think about moves, because they can play into each other. American Airlines, United, and Delta have similar drivers. Although American performed very differently than the other two did this most recent reported quarter, it's important to know that investors in general get some read-through on traffic. They're all buying jet fuel, although Delta has their own refineries, and so they're all going to be facing similar market dynamics. Not always the same, but similar. So, and a lot of people who follow these, particularly the analysts, specialize in the industry, specialize in the space. They do read through. They do take information that they glean from one company and use that as their modeling and trying to price out the other. And then obviously coming up with certain tweaks. So some of those tweaks might be related to, at times when you have unions negotiating with different companies. Sometimes the auto companies, the unions are going to negotiate with one and then the other. So you can have little differences that take place there. And of course you have product differences. But that's an important consideration as well. When you're looking at the expensiveness or relative cheapness of the volatility in Target, if they're reporting the third quarter, it's possible that the options premium is going to be a little bit higher reporting the third quarter than it is when they do their annual, because then you only have one quarter that's unknown, and you're going to get read-through on customer behavior from other companies that are going to be reporting results sooner than they do. And I realize I'm giving you guys a lot of stuff to think about, but it's, and that's kind of what happens. Sometimes you... oh yeah, so Black Mutt Video, I feel like you touched this cross-info concept with Foot Locker and Nike. Yes, that's exactly right. I was looking at Foot Locker, and you'll find that in an old live stream. I don't know how far back this was. But Nike represents a significant portion of Foot Locker sales. And I remember seeing a divergence between the two. I thought, well, how the heck can that be? Is it possible that Foot Locker, suddenly everybody's going to Adidas instead of Nike? And So Foot Locker's not going to be impacted, or Nike's not going to be affected, whichever way it works. But you have to take a look at that, right? So you take information. How do you do that, by the way? Let's take a look at this. I'm going to show you something, which I think is kind of interesting, before we jump, and then I will. So this is the supply chain, suppliers to, customers of, and competitors to Foot Locker. Just using that as an example because it's the one I was just talking about. Look at this. Nike is half of Foot Locker's sales. It's half of the cost of goods sold. Well, that's pretty snappy how quick that was, right? So there's a lot of sort of cross-pollinating information that you can and should get when you look at businesses like this. You know, things don't exist completely in a vacuum. They might at times. You know, you might have businesses that just don't bear any relation, don't have any direct competition, and sell a completely differentiated product that doesn't really have anything to do with anything. But usually that's not true. So you can get some read through, and that's an important thing as well. You know, here we have competitors. I mean, Deckers obviously did very well. Nike, getting a little bit of a pop today. You know, there's some of these things aren't direct competition. Lulu obviously has been growing their top and bottom line over the last couple of years, even as Nike has really struggled to catch its footing. And you know, Lulu operates their own retail outlets, and they do a lot of direct sales, so it's a little bit harder, you know, to try to get a bead on what's happening at Nike based on what's happening at Lulu and vice versa. It's not quite the same thing, but many times there is a very direct relationship. Half of the cost of goods sold at Foot Locker come from Nike. So whatever's going on at one is going to give you some insights on what's going on with the other. And I guess that's as good a place for us to end today as any, since I've chewed up your hour. I always appreciate it when you guys stick around for that amount of time to listen to me yammer on about whatever I'm thinking of at the moment. And we'll be back on Wednesday. So like, subscribe, notification bell, all those good things. And we will see you then. Thanks for watching.